Hi, I'm Sean Clarke, and this is an update for Market Perspectives. So the purpose of Market Perspectives is to give you a sense of how we are thinking about the markets at this point of the year. Being almost halfway through the year, there are some interesting observations, and those observations are sort of guiding our thinking going forward. In particular, what we're focusing on is some rebalancing at the moment, and the reasons for that rebalancing are actually, I think, very sensible. Since the bottom of the market, so when the market corrected in March, about March 30th, it turned around. We've seen a general rally in the stock market of about 20% since that period of time, of which, and you think about it, we've had a flip-flopping, if you will, of the returns that have been coming from both growth stocks and value stocks. Quarter to date, so this is kind of the second quarter update, growth has been up about 20%, where value has been up about half of that, about 11%. And this is as represented by the Russell 1000 Growth Index and the Russell 1000 Value Index. But interestingly, year to date, growth is up about 8.25% versus about 13.5% for value. So there has been attribution by value that in some ways has been masked and not as obvious as what we've seen from growth, because that's where the artificial intelligence momentum has been predominantly generated. The markets have been interesting. They've been whipsawed in many ways by the price of oil going up and down. And right now we're sitting at WTI, West Texas Intermediate, at about $90 a barrel. When that trends higher, we tend to see the market lose traction as that heads lower. For whatever reason, for whatever news is being released that particular day, we see the market actually gain some steam. We're clearly in a risk-on environment versus a risk-off environment. And the way to think about that is risk-on is when growth stocks, when momentum, when technology and communication services are performing very well. The risk-off environment is when we typically see bonds perform a little bit better, but we also see large cap value gain greater traction in terms of its ability to produce numbers and performance. But diversification has been important this year. This has not been exclusively about artificial intelligence and about technology. Emerging markets is, in fact, the best area to have been invested in so far this year, being up 25% year to date. REITs have sort of resurrected themselves from the ashes and have come back. This is real estate that you can buy in the form of a real estate investment trust. Think of it as a mutual fund that holds various components of different parts of real estate. That's been up 10.5% very quietly. And also, interestingly, small caps, which typically struggle in higher interest rate environments, the Russell 2000 so far this year has been up 18%. So there's been distinct benefits from being broadly diversified in the manner that we typically do. Going forward, some of the things that are on our mind at this point is because we've seen such a broad movement upward in technology, again, driven predominantly by artificial intelligence. We feel that it's sensible to start pulling back the reins a little bit. I'm concerned a bit about where the market levels are. Valuations have increased. As valuation levels increase, in fact, to take a step back, valuations for the S&P 500 were about 20 times at the end of March after we saw the pullback occur. In certain tech areas of the market, so the Russell 1000 Growth Index, we're seeing those valuations approach 27, 28 times at this point. Which puts a lot of pressure on companies generating the earnings to support those price levels where they are today. So we are, again, promoting at this time a form of rebalancing. So what is rebalancing? It's recognizing where growth has come from. It's also recognizing where growth has not occurred, in attempting to try to sell in areas of the market while they're high, and spreading that out into different areas to ensure broader diversification and protection, the lack of concentration, if you will, in particular parts of the market. We see at this point going forward a Fed that sort of has their hands cuffed. Kevin Warsh has stepped into the chairman role. He's dealing with an inflationary environment. Obviously, oil over $90 a barrel will produce an inflationary environment that has sort of taken any rate cuts that were seen to happen this year off the table at this point. We may see a rate cut towards the end of the year, but I think it's going to be very much inflation dependent at that point. One of the areas that we're also trimming is international at this point. That was, in fact, an area of the market that we're pretty optimistic about at the beginning of the year for a wide variety of reasons. At this point, with oil having, again, at close, at times close to $100 a barrel, that's going to have a broader impact on the global consumer than it has on the domestic consumer. We've certainly seen stress in certain aspects, socioeconomic aspects, domestically here. And expenditure has changed a little bit, which has obviously GDP ramifications. But we are more concerned about the global consumer and the energy increases and food increases that many of these people are incurring at the moment. So as we move forward, again, we're going to trim large cap growth in favor of adding to large cap value as we see, hopefully we see more momentum in the market broadening. We like certain themes. We think there are some sustainable, if you will, investment themes that are out there. One of them is oil and energy. And if you think about it, if Iran lasts longer than is sort of perceived at this moment, energy increases in the Chevrons, the Exxons of the world, many of the oil producers. This particular sector of the market is likely to benefit and could actually hedge against other areas of the market going down. Aerospace and defense is also a very sustainable theme, and we use that as a satellite position in certain client portfolios where it's appropriate, where they're comfortable with it. We're also engaging and incorporating alternatives a bit more in client portfolios to kind of take up some of the slack that might have otherwise been weighted towards large cap growth. Think of an alternative as an investment that has the opportunity to perform fairly well in any environment. These are strategies that can incorporate options where, again, the right steps in that process can lead to gains in what otherwise might be a market that is trending lower. So I think at this stage right now, we're really trying to figure out how much is left in the tank for large cap growth. In fact, I think that the tank is reading relatively low at this point. That's why we think a rotation of some type is sensible at this point. The realities, though, is that artificial intelligence is not finished driving this market higher. It has moved beyond just the hyperscalers, though, at this point. It's that sort of the artificial intelligence gains that we've seen this year have been more broadly based and there's been more broad participation in terms of those stocks going upward, which is healthy to see. In terms of artificial intelligence and how we might want to think about it, I think there's been a lot of people who have had their finger on the pulse as far as where they think we are in this evolution, in this process, in this sequence, if you will. And I think if you want to use a baseball game as an analogy, I think we can say we're probably safely around maybe third inning of a 9-inning baseball game. This is still very early in terms of the impacts of artificial intelligence on the markets. And I think what's being realized now is in March, we saw the market go down, as I mentioned. That drove a lot of software stocks lower, whether you're as big of a company as Microsoft, to a ServiceNow, to an Adobe, to a Salesforce. There was basically perceived disruption by artificial intelligence in that particular area. Many of these stocks have rebounded significantly from that. And I think we're trying to understand is the traction that AI is gaining and how it can be more universally applied across a variety of different sectors. I think that's what remains to be seen is how stimulative some of this technology is in terms of generating profitability and efficiencies for corporate companies going forward. So we appreciate you joining us for another episode of Market Perspectives. You will see more of this from us going forward. We hope you find this helpful. My name is Sean Clarke, and I am Managing Director at Baldwin & Clarke Advisory Services.